I'm John McCluskey. I'm the president and chief executive officer of Alamos Gold. It's a company I founded in 2003. I founded it off the back of an option to purchase a project in Mexico called Mulatos. This was a mine that within the 2 years following having acquired it, I was able to get it fully permitted and into production. It has gone on over the last 18 years to produce over 2.5 million ounces of gold. We've generated about $500 million in profit. And that was our foundation asset. We've subsequently acquired additional assets in Canada. Those are two producing mines, Young-Davidson and Island Gold. Collectively, the three operations produce over 500,000 ounces of gold a year. Through expansions and other development assets we have in our portfolio, we intend to take production to 800,000 ounces a year by 2028. It's been a tremendous growth company, but it's also been a company that's been very profitable along the way. We've done that by keeping a very strong balance sheet. We're effectively debt-free. We have $200 million cash. We're paying for all our growth and expansion out of our cash flow. So conservatively run, but very much focused on growth and managing risk.
John, welcome to London. Thanks for joining us.
Thank you.
And what are you over here to do?
Well, we have some very large investors that are based here, and we like to come in and see them from time to time. There's a responsibility when you're running a mining company to make sure you're getting a decent valuation in the market. And it's a highly competitive environment, and we have a great story to tell, and that's what we're doing. We're here.
Good. Now, I was listening to your story about, the humble beginnings of this 20-year overnight success of yours. It takes a lot to kind of stay on the straight and narrow, to actually build a mining company, because I always say mining's tough. Things go wrong. It's difficult out there. So for you, what were you doing before you formed this in 2003? Where does the experience come from?
Yeah, I started in the mining sector in the early 1980s. I went to work for a little junior called Alamos, and it would have had a market capitalization well under 10 million when I started. And over the years that followed, it ultimately grew into a $7 billion company, and then it merged with Gold Corp, and then Gold Corp was subsequently taken over by Newmont. So it's all part of Newmont now. But the experience, I spent my first 6 years in the industry working at Alamos and watching that company grow from virtually a standing start to becoming a mid-tier producer. That was a very interesting experience. I learned quite a lot along the way. Subsequent to Alamos, I went out on my own and I started to do more entrepreneurial things. I was quite successful. And then the founder of Alamos, who by this time was a good friend of mine, he came to me and he said, let's do something together. Let's start a project together. And we started Alamos.
It's interesting. So I was listening to the CEO of NVIDIA the other day, and he was talking about his journey, multi-billion-dollar company, but like yourself. And he's saying, I think he was asked, would you do this again? And he said, hell no. Being an entrepreneur is harder than it looks, and there's a lot of bumps along the road. I mean, when you look back, how do you view it?
I think of it almost like a salvation for me. Right. I needed to take on a pretty significant challenge at that point in time. And I was really motivated to do so. I was looking for the right opportunity, and I feel I was very lucky to come across Mulatos when I did, and I was able to secure an option to purchase it. And we caught the very bottom of the cycle when I entered into that option agreement. It was November of 2001. The gold price was $264 an ounce that day I signed the deal. And I agreed to pay Placer Dome $10 million plus a royalty if we're ever able to get it into production. And we were able to pay off the cash portion of that royalty in 2003. And between 2005 and 2019, we produced 2 million ounces of gold, and that's where the royalty was capped. So we paid out the royalty, and we're still going strong. Mulatos was, I don't know how to say it. It was the unicorn. It was a very, very rare project to find. Most oxide heap leach projects, they tend to be quite limited. For example, at that same moment in time, the El Sosol project went into production. But by 2013, it was done. Here we are in 2023, and Mulatos is still growing strong. It's going to produce over 100 million in free cash flow this year. And we can still look ahead a decade or more, and there's much more production to come. So to have had an opportunity to acquire that asset at that moment in time was serendipity in the first order. So I don't look back and say, oh my God, I'd never do that again. It was too hard. It was extremely challenging to do it, but I look back at it as an incredible break, and I do it again every time.
Given the state of the market back then, I guess true contrarian investing, by the bottom, right? If you look back, could you do it again? Were those different times? Because I'm looking right now, you used to put out your ESG report, for instance, recently, and I think it's kind of fascinating. The kind of pressures on mining companies seem to be greater than they once were, or was that not necessarily true?
I don't agree with that. There's always challenges. They'll take different forms, right? But there's always going to be challenges. Mexico, this was a very new jurisdiction. Investors weren't that familiar with it. They'd only changed the laws to invite foreign investment into Mexico in something like 93. So by 2003, this was like 10 years. And most of that time was a terrible bear market. Virtually 1996 through 2006, that was pretty much a bear market in this space. So not a great deal had happened in Mexico by the time we came along and wanted to develop Mulatos. So it wasn't something that investors took a shine to right away. On top of that, with gold price under $300 an ounce, can you imagine what it was like to try to raise capital for a gold mining project in that kind of market? There was a huge amount of skepticism around the space. One of those environments where, in the general press, they were publishing that, gold was long gone, it would never come back. Think of it here. Around the time we were entering into this option to purchase agreement, this was when Barrick was putting on those hedges that were effectively protecting them if gold was to go down below $200 an ounce. Eventually, when gold prices recovered and soared up over $1,000 an ounce, and Barrick's hedge book went offside by 10 or 12 billion dollars, and several other companies were caught in that switch. But we took a contrarian view on gold, and we took a contrarian view on the market, and we saw that bottom as an opportunity.
Right. And talk to me about Mexico today, because again, we have a lot of Canadian companies with assets in Mexico, and predominantly silver, who just are struggling at the moment, and they would like to lay the blame firmly at the Mexican government's door. Is that necessarily so? Is that an explorer-producer difference? How do you view that?
Well, like every country, Mexico goes through cycles. So, where the sentiment can turn very positive for the sector, as it did in the late 90s and early 2000s. The Mexican government was sending delegations up to Canada and to the PDAC convention, but other mining conventions as well, and they were strongly encouraging Canadian companies to come down and explore and to develop in Mexico. And we were part of that first wave. We were one of the first half dozen juniors, let's say, that were into Mexico and spending money and trying to get business done. And those the first 10 years we were there, we actually started, kicking around looking at exploration opportunities in 1994, 95. That's when we're looking at our first exploration assets. We went public in 96. But after the market went into a big downturn, there wasn't much we could do. You know, we basically kept Alamos in a filing cabinet, and we were waited for the market to turn around. Well, that was 97, 98, 99, 2000. Finally, 2001, after 5 years of this very serious bear market, we saw the market was going to turn. And then we wanted to get in on something, and that's when we entered into the option to purchase Mulatos. Well, that was a good guess, but it was a guess. And the market literally started to turn within 16 months. Market gold prices started to go back up again, and we caught that wave. Where are we now? You know, there's very negative sentiment in the market. Despite the fact that gold is well over $1,900 an ounce, there's relatively negative sentiment among investors. I think the combination of that negative sentiment plus a much more socialistic government in power in Mexico right now, that's combined to make it very difficult for the junior end of the sector in Mexico.
Right. Yeah, we'll come on to gold price and margin later on. So if you, again, I just want to stick with you because I want to get to know the man. If I'm going to kind of get into a company, I want to understand what's going on up there, what's the thinking, and you mentioned growth twice in your introductions, and I definitely want to talk about growth for $7 billion company. But the entrepreneurial bit of you was said, I need to do something. I need to do something significant. Most entrepreneurs get bored after a while. 20 years in, what's kind of kept you sustained in terms of the interest levels?
I have not run the same company for 5 consecutive years.
Right.
Every 5 years, the company is completely transformed. So if you can imagine, it was an exploration company of which I was a director, but I wasn't involved in the management at all. That would be from 96 to 2001.
Oh.
In 2001, sort of operating as a director, not an employee, not collecting a salary or anything else.
Right.
I went after the asset and managed to secure it. And by the time I had it and was able to raise the money to exercise the option, at that point in time, I decided to become CEO of the company. At that point, I'd got it off the ground from under $1 million. It was now 15 million market cap, but it was still only 15 million.
Oof.
And there were several steps to be taken in order to move that ahead. But within the first year of having taken over as CEO, I'd moved it off of sort of that $15 million bottom. I'd moved it up to about 60 million.
Mm-hmm.
And
how? What was the shift?
Well, there was first of all, just securing the asset. I mean, it looked like an option that we wouldn't necessarily be able to exercise at one point in time. And there was also 2 companies involved. There was a company called National Gold and ourselves, and we each had a piece of it. And we had to merge those 2 companies together, and I was successful in doing that. And once that was done and the gold price had improved, we started to do the groundwork. We started to do the exploration, the permitting, all the work that would be required in order to move the project forward to get it into production. I mean, if you think about it, we exercised the option in February of 2003. We were pouring our first bar in July of 2005. That means we went from no permits, no water rights, no agreement with the local community, which they call the Ejido in Mexico. We were basically at a standing start in February of 2003.
But what did you walk into? Why? Okay, so today we're talking about 10, 15 years, right, the process. So what did you walk into? What did you buy? What was the option given you?
So Placer Dome had defined roughly, I'd say 2.2 million ounces.
Right.
Of which you could hang about 1.2 million ounces on a 43-101 sort of Canadian definition of what would constitute a reserve. But there was 2 million ounces that you could see. There was another 2 million ounces beyond that they'd done enough work to make that look very promising. And, as it's turned out, it all converted and more. We've gone beyond that 4 million. We're closer to 5 million ounces now. But the fact is that we started to gain some traction in the market by virtue of the fact that the gold price was rising. We were securing permits. We were securing financing. We were moving the project forward very, very aggressively, and people wanted to tag on to a story like that in a rising gold price environment.
If I look at the comparisons to today, obviously some of these people are in your position back then. It's the difference between the gold price is really, really quite good. So it should be a high incentive, but so are costs. So in terms of margins are not necessarily much different from maybe where they were 3 years ago on average. I know you're going to tell a different story. So it's different from that sense, but there's also a lot of very undervalued companies in a tough market in terms of access to capital, a tough market from getting any kind of interest or attraction from investors more broadly. What would you say to those CEOs of those companies? Are there things that they could do today that you did back then?
I would say access to capital is much more difficult to come by. I mean,
right.
the retail sector that was still not quite as robust as it was in the 80s or even the early 90s. There was still some remnants of a retail component to the market. At the time, I was getting the early financing for Mulatos. The big difference in sentiment was at when the gold price was $400 an ounce, there was strong anticipation that gold was going higher. Pretty strong conviction in the market at that point in time. But when we did the feasibility study on Mulatos, we were running that at $375 gold.
Yeah.
So if the gold price assumption was $375 and the actual market price was $400, there wasn't much of a margin in that. It should have been a relatively tough decision for an investor to back a project like that. You practically had to be gambling on a rising gold price, and I was myself, and I suspect most of the investors that backed that project had the very same thought in mind. Right now, you don't need to be speculating on a rising gold price. I mean, we're investing $750 million in the expansion of Island Gold. By the time we're finished that expansion, we'll be able to produce 300,000 ounces of gold a year at Island Gold at roughly $600 all-in sustaining costs. At a $1,900 gold price assumption, that's an amazing margin. I mean, investors can look at that opportunity and just think, wow, there's very little risk in that company not being able to deliver on that.
You're the top end of that scale in terms of the cost per ounce there, aren't you?
That's about the best in the sector right now.
So you're taking you have all of the advantage of a high gold price in terms of being able to kind of create free cash flow and then decide where you allocate that capital. It's always about best return on capital invested. That's what you've got to be thinking all the time, whether that be buying stock back or organic growth or expanding capacity. How are you? Because I did want to focus on you initially. I think we'll come away from that and into the assets proper now. How do you view the kind of growth profile of the company? Where does it come from? Because growth is one thing, making money, the margin, the free cash flow is another, and then what it means to shareholders as well. How do I benefit from it for being a shareholder?
Well, we're always focusing on margin. We understand we're running a business, and the object of the game is to make a profit, make money for investors, and we've consistently done that. If you looked at the return on invested capital from the earliest days of the company, it's basically averaged roughly 14% annually for 20 years.
Okay.
That's a pretty extraordinary statistic, and it's one that's quite easily verified. But that's what happens when you take a company from $1 million to $7 billion. what we have been very astute at doing is, first of all, not making stupid mistakes. You know, if you know of a project out there that somebody acquired and tried to put into production and destroyed all kinds of value in doing so, I can almost guarantee you I was shown that project at some point and turned it down.
Right.
And so for every project that we ultimately acquired, we probably looked at 20 that we didn't acquire. So you have to be able to sort out the good opportunity from the 19 other things that are put in front of you that are ultimately going to.
But you've got your own profile, right? You've got your own profile that works for you because you want something that will deliver scale. Some people will go, well, it's good enough, so it'll work for some, maybe not for others, because they're maybe not, their standards aren't as high in terms of what their expectations are around margin, around profitability, about, quite frankly, sometimes long-term success. So it interests me because you think your expertise is around restarts because of what happened down in Mexico, or do you have a different profile that you look for?
I think there's two things that single us out. One thing is we're very, very patient. Mm-hmm. So we never feel like, we got to do a deal this month or this year even.
Right.
We're waiting for the right moments within the market to do the best deal.
Right.
And we watch things very, very closely to determine, when it's time to move.
Good.
So, for example, when the gold price was sub $300 an ounce, we were aggressively looking for opportunities. We zeroed in on Mulatos and we acquired it. We didn't do another acquisition of any consequence. We got into some exploration plays, but we never did an acquisition of any consequence until 2015, when we merged with Orico to form the next leg of our growth. That brought in the Young-Davidson project. Young-Davidson, after the capital we put in, it now generates over $100 million a year in free cash flow. But when we were looking at Young-Davidson, nobody brought that to us. That's something that we decided we wanted. Well, I would say at least twice a month during those years, the bankers were bringing in opportunities for us to look at. Yeah. And they were clearly things that one should avoid, and we did. So we zeroed in on the one we wanted, and that turned out to be successful. A couple of years after that, again, gold price was about $1,285 an ounce. We acquired Island Gold. Nobody was covering Island Gold. Yeah. Nobody really understood Island Gold, but we did. We took it. We took an interest in it. We looked at it very, very carefully. We saw there was tremendous potential there. That we saw something that the market wasn't even looking for.
What is that? What is that thing that you don't? Because I remember another. Won't name names, but another group who've got the capital. He, as I spoke to the CEO, said, I've trawled my way through this year 35 DFSs, definitive feasibility studies, bankable feasibility studies. 5 of them will ever be a mine. Right? So he was kind of the standards by which these reports are put together. He said, it's kind of appalling in a way, but if you don't know what you're doing, like if you said as a banker, I wouldn't have known either, but. How do you view
feasibility study is not a panacea for, minimizing your risk.
Yeah,
it's a vision of what a project could be. It's an estimate of what the capital is probably going to turn out to be, but it hasn't essentially dealt with every possible risk that you're going to face.
But it's sold to me like that as an investor. I'm like, they've done the DFS.
It shouldn't be
risk-free.
No,
definitely not.
Anybody who comes to you with a so-called risk-free opportunity,
run.
Exactly. And I would say that at the very best, when we go to take something on, where we see a great opportunity, we see all the risks.
Right.
But we decide that these are very manageable risks.
Right.
And we typically have a base case scenario that already looks pretty good.
Yeah.
And then we have our more optimistic scenario, which, if we're right about that, then it's a home run. And I would characterize, all three of the mines we produce from right now, those were all home runs. We for $10 million in a royalty, we picked up Mulattoes. We've made $500 million in profit from that mine, and it's still going. These, if you take a look at when we acquired Island Gold, when the market didn't understand that acquisition, we paid $600 million, just over $600 million US to acquire it. And over the course of the next year, our share price dropped by roughly 40%. So not only did we not get any value for adding it to our portfolio, our absolute valuation declined by more than the cost of the acquisition.
And that wasn't just a case of it's just cost you a bunch of money. It's the fact that the market was devaluing.
The market thought we had taken on a liability.
Right.
They thought it made the company worth less. Well, by 2023, the consensus valuation that street has on that asset is now $2.1 billion. And we've taken it from where we were roughly 1.5 million ounces in all categories when we acquired it. It's over 5 million ounces now, and it continues to grow. The grade has improved it was around 9 grams when we acquired it. It's around 11 grams now. The lowest block that we've defined in our exploration work, it's about 2 million ounces grading 17 grams. In other words, one of the assumptions we were making is that as this deposit would go to depth, the grade would improve. Mm-hmm. Well, now we've absolutely defined that.
Right.
And we've shown the market what this is, and what it is a world-class asset. Well, I think we were very fortunate in spotting that opportunity, but to say that there wasn't some risk, and that would be, if we didn't say we didn't recognize the risks, I wouldn't be telling you the full story. There was risk involved, but relatively speaking, the opportunity was there to be seen. The fact that ore body had been growing in step-by-step fashion in the 3 years prior to our acquiring it. It just happened to be in a market where no one was really paying attention. So this management team at Richmont Mines, they were the ones that actually twigged onto the opportunity. They saw the grade getting better. They did the drilling that started to demonstrate that. They're effectively the ones who should take full credit for that discovery. And I'm giving it to them right now. I'm not saying, we walked in there and invented the wheel or anything. All we did was, we turned the wheel into a nice little wagon, and now we're rolling down the road on it. And, we feel very, very, grateful for the work that they did and the fact that we were able to capitalize on it. But we knew we were in a position to do that. We put ourselves in a position to do that.
It's interesting. Again, it interests me, all of this, because I guess you get to press and it's a very rare thing, you get to press the "I told you so" button on that. But there's a lot of hard work to prove that you were right between then and now. And I'm just wondering, and sort of when I say listen to you, it feels like there's a little bit of, there's a whole bunch of data and science and systematic approach to increasing efficiencies and, driving those costs down, increasing those ounces produced, backfilling reserve and resource numbers. But there's a little bit of that entrepreneur still in there, taking those calculated chances on things that perhaps people, may not do. Is that right? Do you feel that about yourself?
It is. We're very much, this company was started in the spirit of entrepreneurship. I mean, I didn't come out of a major mining company, for example. I started in the mining industry in a little junior. Glamis was an $8 million company when I joined it. It was an office full of old stock promoters, Chester Miller and Jim Billingsley. These old guys had been involved in some of the really great discoveries that had happened in Canada in the 1970s. They were already quite wealthy by the early 80s, and they decided they twigged onto something new. And the new thing was open pit heap leaching. This was in the very pioneer phases of open pit heap leaching. And Chester Miller said, there's something to this technology. I can really make something of this. I can take very little capital and I can make a gold mine. Yeah. And he twigged onto this. He got involved in a project in Southern California called the Picacho Mine. That's about the time I came along. The first year that I joined the company, he produced 7,000 ounces of gold, but he'd proven the concept. And that company went on to generate phenomenal profits. But, there's entrepreneurship. You see a technology, you see how you can actually turn, what would be otherwise a marginal or loss-making mineral deposit, and suddenly you've come up with a way to actually turn it into a profitable operation. Well, that's entrepreneurship.
I remember Doug Ramshaw, I think you were talking about Chester, and he was sort of very effusive and very warm memories of him for sure.
Chester Miller was 56 when I met him, and I was 23.
Yeah.
He would have been about 88 when Doug Ramshaw met him. He's still going. Right. He's 96 years of age, and he's still going strong. But the fact is that, when Chester Miller was a 56-year-old mining entrepreneur, that guy was
100 miles an hour.
Exactly. And basically, I had to run to keep up with them. And you learn a lot from an experience like that.
You do, and it's exactly where I'm going now. So you've kind of built this thing out. You've got a huge, 1,900 odd people right throughout the organization, but there's a team under you who need to learn from you, and I'm sure are learning from you. What are the things that you point to in terms of defining the type of company you want to be, the way that they should do business, and don't make silly mistakes. So what when you're passing stuff down to the next generation, what are you telling them to focus on? What's important?
Well, first of all, I would point out the fact that I learn as much from my team as they learn from me. We're not one of these stratified organizations where the decision is handed down from on high and it sort of filters through the various levels. We're a very lateral kind of organization, and decision making. It's really, there's a small group of us. We sit around our board table, and we hash it out. And generally, when we're ready to move on something, there's consensus around that table. And we're fortunate to we really have some of the smartest people in the industry working for us. I would just point out as a case in point, Chris Boswick, who's our Vice President of Technical Services. So who's Chris Boswick? Well, here's an example of what Chris Boswick pulled off earlier on in his career. He was in a similar role with Barrick Gold in the early 1990s when Barrick Gold was looking at a little junior called Arequipa Resources. Arequipa had 9 drill holes and 20 pits. That's it. And he extrapolated from that very limited amount of data that could potentially be a 5 million ounce gold deposit. And on the strength of that call, Barrick invested like $1.5 billion in, this is it'd be about 94, maybe 95, $1.5 billion to acquire Arequipa Resources. It was a major win for investors. Turned out to be a big win for Barrick as well, because it went on to produce much more than 5 million ounces of gold. In other words, how do you account for that kind of technical insight? You're basically,
safe to say it's pre-AI, so real thinking going on.
It's coming down to geostatistics. It's coming down to a really good understanding of the geology of that model, which it was really in its formative stages. There was a bunch of things that went into providing the insight to confidently recommend the acquisition of that deposit. Now flash forward to 2017, and we're looking at Island Gold. Well, Island Gold, at the time we acquired it, it had roughly 1 million ounces of reserves, and it had another 500,000 or 600,000 ounces of resources, but it probably had, I'm going to say 5 or 6 1,000 kilometers of drilling done on it. There have been massive amounts of drilling historically done in this district. In other words, he wasn't trying to guess on the basis of 9 drill holes. He was able to look back over a whole body of data. And this was not that appreciated by the market. And what we also did is we just didn't take Richmont Mine's data and try to make a guess from there. We took all that data and we modeled that deposit ourselves. And I would argue that by the time we made the decision to acquire that asset, we knew more about it than the people selling it to us. We had more insights into what would probably occur in terms of how that would develop than what was probably understood by the people that sold it to us. And that's where you have to get to. And not only did we come up with that interpretation, we did so in under 2 months. So the ability to get to the right answer and the ability to get there quickly, that was a big differentiator. Now, at the time, there were several major mining companies with deposits in Ontario that practically had to drive past this mine to get to their own operations. You'd wonder why weren't they stopping and having a look? I mean, they employ entire teams to do just that.
Wood for the trees.
That's why you need smaller companies in this sector, because we will be the ones to look at some of the smaller things and take a risk. And well, look how it turned out for us. We've created a $2 billion asset that even before we finished the development, we're generating tremendous profits off it. I mean, we're producing roughly, we produced between 130 and 150,000 ounces of gold a year. And our costs have been around $1,000 an ounce. So it's been very profitable for us. And we're using the cash flows that we're generating from that operation to actually pay for the expansion.
Yeah. Let's come back to that word growth. Okay. $7 billion company. It gets harder to tell that story convincingly, right? So you've got to have an eye to the future. And you said every 5 years you've had a different company that you're building out. So I'm intrigued about what the next 5 years looks like for you in the context of growth, the backdrop of growth, because we've got the producing assets. What sits under that? How do we backfill or fill in these ounces or replace these ounces now and into the future? What does that look like?
The biggest single capital project that we've ever undertaken is the expansion of Alamos Gold.
Yeah.
At $750 million, we've never done anything that big.
Organic.
Now that takes us from 130,000 ounces where we are today. It'll take us to 300,000 ounces of production at considerably low costs. So that's a huge growth step. And it's organic growth. It's a fully permitted project. It's one, we're mining from it now, so we understand it really well. From that point of view, it's a very de-risked step that we're taking here. Long before we even announced to the market that we were ready to do the Phase 3 expansion, a part of that Phase 3 expansion was the expansion of our tailings facility. Well, before we made the announcement, we completed the expansion of the tailings facility. So we sort of do things like that in a very quiet way that de-risk the growth step.
Right. Okay.
And so we're quite confident on the basis of this expansion. By 2026, when it's done, we're going to be operating at over 600,000 ounces of gold a year. Behind that, we have a project called Lynn Lake. Now, Lynn Lake is an equally interesting story. We actually picked up Lynn Lake almost by accident, because when we acquired Young-Davidson, we took over a company called we took over Orico Gold, and Orico Gold had a joint venture with this little company, which had the Lynn Lake project. But the joint venture structure made no sense at all. So I went to the chairman of that company and I said, we should just probably acquire you, because they were trading at a $13 million market cap, and I was now required to spend $20 million for 60% of that project.
Yeah.
I said, well, why don't I just take you out for $20 million?
Yeah.
And that gives you And so that's essentially what we did. So we acquired that project for, I think it was $22 million at a point in time when the gold price was under $1,100 an ounce. It was like January of 2016. So where is it now? Consensus value on that project now is about $450 million. Not bad for a thing you acquired for $22 million.
7 years ago.
We finished the permitting on it now. We've expanded it from 1.6 million ounces. It's currently trading at around, it's currently sitting at around 2.6 million ounces in our mineral inventory. And based on some satellite deposits, we think we can get it well over 3 million ounces.
Yeah.
So, we've made that, and we continue to make that an ever more valuable asset. And by the time we put it into production, we think we can have it in production by 2028. That'll take us to 800,000 ounces. So we already, from an organic growth perspective, we already own enough in our pipeline to take us from this 500,000 ounce a year level to 800,000 ounces.
Explain to people, I know it's obvious, blindingly obvious, but it's worth explaining to people. If you've got mid-tiers or larger boys looking to buy ounces, if they're going to the market and say they're buying a Great Bear, 1.6, 1.8 billion, whatever it was, why does your organic growth, more advantageous? Is it purely on a cost basis, or is there a time component to that as well? I mean, why not go out and use some of your money and just go buy some quick ounces somewhere else?
Well, I've done that. If you look at the acquisition of Orico, or the acquisition of Richmont Mines, that was the whole purpose. You were bringing in, they were producing mines with a lot of organic growth opportunity. So we're willing to do that when we see,
when it makes sense.
But yeah, at the time we did that, the gold price was trading at $1,100 an ounce. So not too many competitors, really low cost acquisitions. And when we were saying we think we're at the bottom here, and that's why we're acquiring, all you could see is the gold price had dropped from $1,900 to $1,100. You couldn't see the other part of the curve, right? So now, though, in 2023, with gold back at $1,900 again, you think, wow, yeah, now we've got a parabola here, and you guys were acquiring at the very bottom. How did we know it was the bottom then?
Yeah. Does it, and I guess where I'm going, because lots of people want to get on the conversation about M&A broadly in the market. The market's being shaken up at the moment because there's a lot of, we've talked about previously, value destroyed, etc. So do the big boys usually, and it's a kind of cliche, when the market's at these sorts of dizzy highs in terms of gold price, they come and buy stuff out there. Are you saying that the market conditions now should logically prevent big companies going in and making expensive acquisitions, and you should only buy at the bottom, or is there no real kind of
in some cases,
ideal time?
In some ways, M&A is a relative game, right? So if I'm sitting at a multiple, if I'm trading at 1.1 times NAV,
right, and
I'm looking at a company that's trading at 0.3 times NAV, I can make a very good case for acquiring it because I've got a much stronger paper to play with there. And to some extent, you'll see companies capitalizing on that. Other than that, other than the fact that sentiment for undeveloped projects is at an all-time low.
Yeah.
So if you happen to have spent a lot of money developing a mineral deposit, you're probably not getting a good valuation on it in the market right now. So that does create opportunities for acquirers. Then you'll get companies that will just find good synergies, as we did with Orico, for example. They were a small producer. We were a small producer. We put those two companies together, and we created something more than either company was worth on its own. And had we not done that deal, we probably never could have done the deal on Richmont Mines. But now, collectively, the effort that we put into establishing a Canadian business, because remember, we only had one producing mine in Mexico and no exposure in Canada at all before 2015. And by 2023, 90% of our net asset value is in Canada, right? So why did we do that? Well, we perceived Mexico as getting riskier in terms of political risk. We looked at other places in the world. We saw the whole world seemed to be getting riskier. And we also looked at the value of Canadian assets and saw it didn't cost much more for a Canadian asset than it did for an asset anywhere else. The market just wasn't differentiating. So we thought they really should. And so from that point of view, the good opportunities were in Canada. And that's why we focused there.
Right, Sean, I'm getting signals from the team behind the camera. We've talked far too long, and I've enjoyed it far too much. But we better wrap it up. And I'll just let you finish off with, right, you obviously, last 3 years have been good to you, good to your shareholders. What have we got to look forward to in the next 12 months?
Well, it's a strategy that we don't pursue in terms of 12-month increments. It doesn't fit that neatly. But our sort of multi-year strategy is to sort of build out our portfolio by wisely investing our capital in order to expand our production and lower our costs. And every step we take in this regard, it's all a de-risking exercise. By the time 28 rolls around, we're going to have 4 producing mines generating 800,000 ounces of production at sub $1,000 all-in sustaining costs. That's massive cash flow generation. If we're at a $2,000 gold price, we're going to generate tremendous amounts of cash. That hopefully is going to mean higher dividends for our shareholders. We've been paying a dividend since 2010, but it'll allow us to pay even more dividends and allow us to look around the world to see if there's more opportunities.
John, thank you very much for your time.
Thank you.
Cheers.